Hey everybody, welcome to Wednesday Wisdom. It's Clarence, the Mortgage Man. I'm with Veritas Funding. Today I want to talk to you just briefly about credit. Your credit score is really a perceived risk. The higher your credit score, the lower the perceived risk. The lower your credit score, the higher perceived risk. And a lot of people, when they apply, they don't understand how their credit works and how the decisions on lending are going to be made. One of the things I like to do when I get an application with a new client is to take a few minutes and review the credit. A lot of times lenders will just look, if they see a certain score, they're off to the races. But it's a very good idea to go down through each line with the borrowers, whether it's good stuff or bad stuff. Ask some questions about that information because a good lender is going to want to paint a picture to the underwriter. I always tell people that's my job, to make you look worthy to an underwriter who's sitting down looking at numbers. Okay? Different things happen in your life. Different things may have caused you to lose your job, like we got COVID going on right now. Different things happen that affect good people. The key is, how long has it been since that issue happened and where you've been since then? Meaning, if you had an issue a year ago, have you been back on track? That plays a factor. I think 12 months is a good determining factor. 24 months is even better. So I can say to underwriter, yes, they had this event, but look how well they've done since then. Do you have repossessions? Do you have collections outstanding? All these things paint a picture. But the key thing is a term called ATR, which is the ability to repay. That's going to be more important than anything, because a lender is going to look at all these factors to determine if you have the ability to repay this loan. So, first things first, guys, understand what's affecting your credit. Number one is the utilization, how much credit you have and how are you using it. For example, if you have a credit card with $1,000 and you have a balance of $100, looks like you're managing that debt pretty well. Versus if you have a credit card with $1,000 and you have $900 on there, looks like you're probably on the riskier side there. It doesn't look like you're managing your money very well. Now, don't get me wrong, there are ways to dance around that issue if you know when your credit card reports to the bureaus, and that's something we could talk about down the road. Also, number two is the length of your credit. How long have you had credit? How long have you been showing the ability to repay debt back? All these things matter. Obviously, if you have repossessions, judgments, foreclosures, that's going to be a reason that a lender may look at you going, wait a minute, let's see if we want to lend this person. You might not get the best interest rate. But again, like I tell you guys all the time, interest rate is all strategic. If it gets you to where you need to be, don't worry about the rate, because there are ways to get you back into what would be considered a great rate. So with your credit, again, guys, it is just understanding what it is, how it affects you, and your ability to buy. The first thing you want to do before you get in a car with a real estate agent, or before you jump on, you see a commercial and it's advertising rates in the twos, you need to make sure that you've taken a look at your credit profile. One of the things I do as well with my clients is we help them get their credit scores up. There are tweaks and little things you could do to get your credit score up 3 or 4 points, 10 points, 60 points, 80 points, whatever it takes. And that can make the difference between a very high interest rate, a very low interest rate, and the type of programs you qualify for. Now, obviously, every lending industry is going to have different matrices, different things they can do for different customers. So we want to make sure that we put you in the right situation, and that starts by understanding your credit profile. Credit is just the algorithm that the FICO industry uses to determine what loan is the best for you. And I shouldn't say FICO industry, I meant to say FICO is what we use. A lot of times people will say, hey, I have Credit Karma, and it says I have a 700. A lot of times that's a different algorithm, and it's not going to be the same that a lender uses. I always tell people Credit Karma is a good way to monitor your score if there's any new things added, but we're going to use a different algorithm that our investors have decided is going to work best for them making the decision if they're going to lend to you. It's like this. A simple way I can explain to you is, if someone loans you $1,000, you pay them off on time, they're going to say, hey, that person's good, they have good credit. If someone loans you $1,000 and it takes you a long time to pay them off, you're going to have higher perceived risk. It's just what it is. So, short, quick tips: have your credit looked at, understand why your credit is what it is, and then understand strategies to fix it. All right, that's it for Wednesday Wisdom. What is the moral of this story? Have someone look at your credit before you do anything, so you know what you may need to fix and what you don't need to fix, or what's on there. A lot of times there are erroneous information on there. So it's a good idea to have someone sit down with you and go over what they see. and then you can be in the best position to buy, refinance, or buy an investment, whatever your situation is. All right, mortgage man saying, results starts when you do.